begin, inshallah. My name is Ali Rada Walji. I am the CEO at ShariaPortfolio. Alongside myself, I'm joined with Brother Nashad Virji. He's our portfolio manager. He is also the founder and CEO of the family of Sharia portfolio companies under SP Wealth. And so there's a lot more that you can learn about if you're new to the Sharia compliant investing space. I would encourage you to visit sp-wealth.com, and you'll be able to see all that we represent in the halal investing space. And together with me as a panelist, we also have Sheikh Umar Khan. He's our Sharia advisor. Some of you may have met him at our webinar, a couple months ago. But for those who are new, we're blessed to have his presence with us. He has, he's an alim, a mufti in the Islamic sciences, and also has background in a master's in Islamic finance, as well as, a lot of certifications within AOFI and other, programs. He works with a lot of firms and helps them on the Sharia guidance side. And so, we're blessed that he was able to join us. If you want to catch more on his introduction and the work that he's doing with us, you're welcome to tune in to our earlier webinar, which is available on our YouTube channel. So feel free to check that out if you haven't already. But he will be, inshallah, kicking us out with a little bit about, what are the Sharia compliant guidelines that we follow, and how do we ensure Sharia compliance. Following his start, we are going to, inshallah, then move into some of the updates from our portfolio manager, Nashad, who will be, inshallah, going over some of what happened within 2022 within our portfolios, and kind of give you a little bit more color as to kind of the different strategies that we have and manage for our clients. And then, inshallah, we'll be looking a little bit into the outlook for what we think may be happening as we go forward. I'll be covering some of that as well in the growth portfolio commentary and discussion. So it's an action-packed night. And I know it's evening or afternoon somewhere else, I'm sure, but we are, again, truly honored to be here with you to start off the year. And without further ado, I'm going to turn it to Sheikh Umar Khan. Assalamu alaikum, and welcome again for this important session.
Wa alaikum assalam wa rahmatullah. Bismillah, walhamdulillah, wa salatu wa salamu ala rasulillah, wa ala alihi wa sahbihi wa man walah. So I've been asked to speak about the process that we follow for ethical investing at ShariaPortfolio. And I just wanted to start briefly with the concept of what is Sharia compliant investing, or Islamically appropriate investing, or in other words, ethical investing mean for the individual to start with before we talk about ShariaPortfolio. So all of these words basically mean the same thing. Sharia is to follow the path of Islam. So Islamically compliant investing. And Islam is nothing but a set of ethics, right? Believing in one God is also part of our ethics, and to do everything from an ethical perspective. That's the idea. So number one, in Islam, it is highly, highly encouraged to invest money to begin with. And it is highly discouraged to have your cash just sitting around doing nothing. Now, obviously, there's a difference between having some emergency cash in your account for emergencies and needs that you may have. But generally speaking, the idea in Islam is to encourage investment. And it's not considered something that's optional. It's something that's necessary. It's something that's highly recommended in Islam. And that is why we have a hadith either attributed to the Prophet ﷺ or Umar bin Khattab. It's unclear. In the Jami of At-Tirmidhi, the Imam says that we're not sure if this came from Umar bin al-Khattab or if it came from the Prophet ﷺ. But regardless, the point is valid. And we also find the same in the Muwatta of Imam Malik, where he says, فَلْيَتَّجِرْ فِيهِ وَلَا يَتْرُكُهُ حَتَّى تَأْكُلُهُ الصَّدَقَةِ. Where basically what he's saying is, when you have the wealth of an orphan that you are responsible for, make sure you are investing it and you don't just leave it, because if you leave it, then zakah is going to apply to it until there's no money left. And look at the time that we live in nowadays. it's not just zakat. We have an extremely high rate of inflation. So if you just have money sitting around, not put to work for you, you will be losing its purchasing power. Inflation will just eat it away. And not only should you be trying to grow it, but it will continue to shrink because of zakat and because of purchasing power. And for this reason, it is highly encouraged in Islam that you invest in a business, because when you invest, then you don't pay zakat on the entire amount of the stock, right? When you invest in a business, you pay on a fraction of it. So getting back to how do you invest? Islamic investing starts with investing wisely. Are you investing in a good company? Does it have good management? Are there prospects of growth? Are you taking too much risk or appropriate risk? Don't be reckless in how much risk you take. Have you studied the company financially and studied its fundamentals, performed evaluation analysis? Have you done the discounted cash flow analysis? Have you looked at its cash flow? Have you looked at its PE ratios, the PEG, the multiples, all the ROA, ROE, where's it going? What is the fundamental and technical analysis you've done? All of this is aligned with our values, because there's a hadith in Bukhari where the Prophet ﷺ said, Inna Allah harrama alaykum. And he says, Allah has made haram upon you. And then he makes a list of things. And one of the things he mentions is ida'at al-mal, wasting money. And the scholars say that if you are investing your money or spending your money in something that is not a good investment, you are wasting money. So you need to make sure you've done the financial analysis. You need to make sure you've diversified your portfolio, that you've reduced your risk through systematic diversification. And these are things that, of course, ShariaPortfolio does on your behalf. They go through, they evaluate the stocks, they perform the analysis, they build a portfolio, they work with you, and then they make sure that the portfolio is diverse, right? And as we're investing, we make sure we have good intentions. We make sure that we want to invest in companies that are creating good for the world, that are creating good products, services, creating jobs. They're beneficial for the economy. They're good for the climate, for example, electric cars. We don't want to invest in companies that are engaged in haram, like pornography, like alcohol, or those that are producing or proliferating or propagating goods or services that are harmful to society. So we make sure we have this intention, right? We make sure we are not just investing so that we can get some money out of it. That's good. Of course, that's halal, it's recommended, but we also invest in a way that we make sure we are promoting good business. We are benefiting the world in other ways. And this increases our rewards as we invest. However, we also have to go beyond the intention and make sure we're doing things right. And in order to do things right, the scholars have created a set of standards. And there's a variety of different standards that exist globally. There's standards from Malaysia, from Indonesia. And one of the largest organizations that creates financial standards for investment is called AOFI. And AOFI basically says, if you're going to invest in a stock, how do you know that stock is halal? And there are effectively three broad things that are looked at. Number one, is the business that you're investing in doing too much haram? Because maybe a little bit of, every company nowadays, we know we're living in a time where every company has maybe a little bit of interest or a little bit of haram dealings from an Islamic perspective, but that little bit can be ignored. But if it's too much, we should not be investing in that company. So there's a ratio that looks at how much of the business is in haram. And if it's more than 5%, that becomes a problem and we cannot invest in that company. There's two other factors that are looked at, and these are based on the concept of riba, or basically interest-based loans, because we know that interest is haram in our religion. And so what these factors are looking at, number one is, does the company have so much cash invested in instruments, in bank accounts or certificates of deposit or some sort of instrument where they are earning too much interest on it? And if they do, again, that company is disqualified and we cannot invest in that company. And the final one is, we look at the capital structure of the company. Has the company taken on too much debt? Is it debt-based? And if it's too much debt-based and therefore has to pay too much interest, then again, we have to rule that company out and make sure we are not investing in it. So these are the three basic formulas, the three basic things that the AOFI standards look for and what ShariaPortfolio follows. So how do we do this? We rely upon third-party providers. So first of all, we make sure we select the best providers that we can, conducting a thorough analysis in the selection process, making sure that the company that's providing us the feed of data to make sure that these ratios are being met, that we aren't investing in too much haram or taking too much interest or giving too much interest, we make sure that that third-party selection is done well and properly. And once that's done, we continue to get a feed of data from this provider to make sure that our stock selection is done in a halal, in a Sharia compliant manner. And every equity that is selected is then evaluated internally by the Sharia advisor to make sure that we are making sure there's no other issues associated with that stock, that business as well. And then once such decisions are made, so let's say a particular stock is purchased, it's added to the portfolios of the customers, there's an ongoing process of maintenance as well. So as any good financial portfolio, as any good financial firm that's investing does, ShariaPortfolio has a portfolio rebalancing approach. And so every so often, the portfolio is reevaluated. Are the stocks in it good? Are they halal? Are they Sharia compliant? And if they are not, at that point, anything that is not Sharia compliant is disposed of. And then the next time that happens again, the entire portfolio is evaluated again. So I know that's a simple description of what we do. If people have more detailed questions, we can go through that. But inshallah, hopefully that is sufficient to help you understand the process that's followed. Jazakumullahu khairan, subhanakallahu bihamdik, ashhadu an la ilaha illa ant, astaghfiruka wa atubu ilayk.
Jazakallah khair, Sheikh Umar. That was a very insightful introduction on the Sharia process that we follow. And, it sounds pretty straightforward, but there's a lot of work that has to be done behind the scenes. And we're grateful for scholars like yourself who have enabled, paved the path for a lot of the practitioners in this space to ensure that we are aligning ourselves with the guidelines and hopefully continuing to serve the community in a manner that would not be violating the Islamic principles, inshallah. So with that, I thank you for that. And we'll turn to Naushad Virji. He's going to go over his presentation with regards to the markets and last year's performance. And inshallah, after his section, I will be continuing on with the growth models and some of the market commentary as well. So without further ado, Naushad, you can take it from here.
All right, assalamu alaikum, and thank you for that introduction, Ali Rada, and thank you, Sheikh Omar, for those insightful comments. We get a lot of questions about Sharia compliance and how to screen for stocks or what it means to be compliant. So I think that was a very good description, and appreciate that. Let me start off by sharing my screen. So just give me 1 minute to get this up and running.
As you're doing that, Naushad, there's a question that came for Sheikh Umar while you get your slides ready, which asks from Surah Humazah that who amasses wealth greedily and counts it repeatedly. So he wants a little bit of reconciliation with encouraging investing while balancing amassing and greedily kind of amassing wealth. So I think that's a good question. And inshallah, if you do guys have any more questions, feel free to use the Q&A section to post those, and we will attempt to answer those towards the end as well. But since this came through, Sheikh Umar Khan, you want to address that before we jump into the market commentary?
Yeah, Jazakallah khair for the question. It's an excellent question, and there are many places in the Quran you will find something similar. So in Surah At-Tawbah, you find إِنَّ الَّذِينَ يَكْنِزُونَ الذَّهَبَ وَالْفِضَّةَ, and so on and so forth, which describes basically that someone who is just hoarding wealth, they will be taken to account on the Day of Judgment. And Allah provides a very graphic description. And He says, those who are hoarding silver and gold, that gold will be taken and it will be heated in the hellfire, and that person will be burned with that gold and told, hey, here's the gold that you accumulated. What is this referring to? When Allah talks about hoarding wealth or being greedy with wealth, what is this referring to? Most of the scholars, when they interpret these verses, they explain that these verses are talking about when you hoard wealth without making sure that you are properly fulfilling the rights of the people on that wealth. So the number one place that you need to fulfill the rights is to make sure you're paying your zakah. If you are hoarding wealth and you are not paying your zakah, that is going to haunt you and trouble you. And like I said, Allah describes it in scary ways in the Quran, that you will be taken to account for that in a way that just should make anyone get very scared about it. So in many places in the Quran, Allah talks about greed and wealth, and also in Surah Al-Takathur, Allah says, and right next to the surah that you quoted in Surah Al-Humazah, Allah says, Alhaakum at-takathur. Those people who are busy with just distracted getting more and more and more and more. And Ibn al-Qayyim and other scholars explain what this means, and they say what this is referring to is, again, those who are so either distracted with wealth to the point that they are not fulfilling their obligations. They are not completing their prayers. They are not taking care of their parents. They are not taking care of their children, their spouses, their family. They're not earning they're not doing other things that they need to do. So an obsession with wealth to the point that either you are not fulfilling your obligations or you are not taking care of zakah, that becomes problematic. But to earn money and to have good intentions for both using that money as well as saving that money for retirement is perfectly acceptable. We learn from the life of the Prophet ﷺ, and I'll end on this point. We learn from the hadith and from the life of the Prophet ﷺ that he would go and invest in, and he would engage in business to the point of trying to save up for a year. Right? He wanted to make sure he would try to have enough savings for some period of time. Now, there were times when he didn't have savings, and when we have those hadith as well, when he went hungry for some period of time, and so on and so forth. But he would try to save money, and he gave this advice to Sa'ad bin Abi Waqqas as well. When he was trying to give his money away, he said, don't give all of your money away. Keep some of that money for your family. So when you pass away, your family also has access to that wealth. So nothing wrong with the fundamental concept of wealth. We just have to make sure we're not being greedy, and we have to make sure we are giving proper zakah.
Jazakallah khair, Sheikh Umar. So we'll go back to Nashad, and I say if you guys have any more questions, feel free to submit those, and as time permits, we'll try and attempt to answer those towards the end, inshallah.
All right, fantastic. Ali Rada, can you guys see the screen? Can you see the title page in review?
Yes.
Fantastic. All right, Bismillah ar-Rahman ar-Rahim. Again, my name is Noshad Virji. I'm the founder of ShariaPortfolio, and I'm also the portfolio manager for the value models, which we started the firm with back in 2003 and that are still going strong to this day. Before I get started, I'm going to put up our disclaimer and just emphasize that this is a general discussion and commentary only. This isn't intended to serve as investment advice, and I want to encourage everybody to speak to your financial advisor for a one-on-one session to receive suitable personal recommendations. At ShariaPortfolio, we have quite a few financial advisors around the country and also in Canada. And if you're looking for some help, you go on our website and you can find an advisor that's nearby who can help you one-on-one. Our company it has come a long way since 2003. We currently collectively manage about 500 million in assets, and we actually have clients in about 12 different countries at this point. So alhamdulillah, the demand for Sharia compliant investing is there. And I really love the fact that we're with a firm that allows you to invest without compromising your personal values. So you can invest without having to do things that go against Islam. So as Sheikh Omar was suggesting, you know, we are able to invest, we are able to save, and you know, as long as we're not hoarding, you know, we're trying to look out for ourselves, for our families, and inshallah, we can do that without compromising our personal value system. So today, we're gonna cover our year in review. We do this every year. So today's session is about 2022, a very interesting year. We're inshallah going to cover 3 different sections today. So we'll start off with a presentation on our various investment offerings. So you can see all of the different options and styles of investing that are available to our clients. We'll then talk about the market performance in 2022, and then we'll proceed with a discussion on our outlook and expectations for 2023. So let me go ahead and get started. I'm going to move forward quickly because I want to make sure that I leave enough time for a Q&A at the end. So let's start off with investment styles. There are a couple of different investment styles that a lot of people are aware of, but a lot of new investors don't know exactly what this means. So I want to spend just a little bit of time on this and just explain that there are two major investment styles. One is passive investing and one is active investing. Now, it's important to understand that these are two different approaches and they work differently, and it's not necessarily that one is better than the other. It just may be that one is more suitable depending on your situation, or you might have a preference over one over the other. So with passive investing, we focus on ETFs, which are exchange traded funds. So ETFs are passive vehicles. They're basically funds that just invest in an index. An index is like the S&P. S&P 500 are the 500 largest companies in the US. So if you invest in an S&P ETF or an index, then you're basically just buying into those stocks. In our case, we want those stocks minus anything that's not Sharia compliant. So with passive investing, you're buying ETFs that are basically indexed to Sharia compliant securities. Now, when you buy this basket of stocks, you're buying 200 stocks or more in one purchase. So this is a good way to decrease risk. If you buy one stock or even two stocks, you're putting all your eggs in one or two baskets. When you buy an ETF, you're able to decrease your risk because you're buying into a basket of securities. In the case of the S&P, we're buying 200 of the 500 stocks because those are the ones that are Sharia compliant. One of the advantages of passive investing is also, apart from decreased risk, it's also a lower cost because there's less decision making. As a portfolio manager, I don't necessarily have to decide that this stock is going to be in the fund and this one's not, apart from the Sharia compliance. So as a result, I don't need to spend as much time deciding what's going to be in the basket of stocks. And so we pass the savings on to our clients in a lower cost. This is more of a buy and hold strategy. So when you're buying an ETF or buying funds in general, you can buy and hold for a longer period of time. And this type of strategy tends to be more suitable for smaller investors or those with much lower risk appetite. So someone who really just wants to try and achieve the market return and isn't looking to do anything fancy or necessarily any personalization or tax strategies can find passive investing to be a pretty good solution. It is a buy and hold solution, so you don't see quite as much buying and selling. And at our firm, we have 6 different investment strategies to choose from under the passive style. Now let's talk about the active style of investing. So active investing is where we focus more on individual stocks. So when you're thinking about people who are trading or buying and selling stocks, or when you're watching the stock market on the news and you see people, buying and selling, this is an active approach. You're making decisions on specific stocks rather than funds. The advantage of an active approach is, first of all, personalization. The stocks in a portfolio can be personalized specifically for your situation. We have a lot of clients who come from larger companies like Apple or Microsoft, and generally they have a lot of stock options already in their retirement accounts. So they don't necessarily need as much exposure to technology or even their own company stock. So with an active approach, we can look at what you already have and then create a solution that complements your stock holdings or whatever else you might already have going on. So that level of personalization you can only achieve with an active approach. We're also able to offer tax loss harvesting, which means at the end of the year, if we have a lot of gains, we can sell any stocks that might be at a loss to offset some of those gains to try to create a little bit more tax efficiency. So this is a really important point because with an ETF, you can't control that, okay, I'm only going to have this stock and not that stock. You're getting a whole package. With active strategies, you can actually control your tax situation a little bit better. You can also focus on tactical maneuvering. So when you have years like last year's where the whole market has been going down, with active strategies, we can try to take measures to try to beat the S&P or beat the markets. If technology is doing really poorly, then we can reduce our exposure to technology and invest maybe in healthcare or consumer defensive stocks. So that tactical maneuvering can be really valuable to help outperform the markets. And so the active strategies allow us to do that. These type of strategies are more suitable for those wanting to maximize their long-term returns and also achieve some level of tax efficiency. So most of our clients really like the active strategies. We're one of the very, very few firms that offers active solution that's totally focused on Sharia compliant investing that also allows personalization. So if you're looking to find something other than a out-of-the-box approach, something that's really personalized for your situation, our active strategies might be worth looking at. We offer 5 different investment strategies in 2 different approaches. We have a value investment approach and we have a growth investment approach. And I'll talk about that more in a minute. But these 2 styles, the passive and active, are both very relevant, and our clients are able to choose either or even both. We have clients who will have passive strategies for maybe their education savings or active strategies for their long-term retirement accounts. So these are both good strategies for different situations. Now let me talk about investment approaches. Within the active strategies or active styles that we offer, we have 2 approaches. One is called value investing and the other is growth investing. Different from each other, and depending on the client, one may prefer one over the other, or it could be the market that pushes you into one or the other, depending on what's doing better. In previous years, we've seen growth do really, really well. Last year was one year where value actually outperformed. So these 2 approaches, it's good to have. It's like having a menu with different choices. When you go to a restaurant, maybe you don't feel like burgers, maybe you feel like spaghetti. Having all these different menus, menu options can really help you over time, and people's circumstances change over time. So the value approach is the approach that we've been using the longest. And that's where we buy companies that are trading below what they're worth. If you've seen any of my presentations in the past, and we have a lot of them on our website, we go into a lot of detail about this. So I don't want to spend too much time on drilling down into value investing, but basically, we're looking for companies that are trading below what we believe they're actually worth. One of the advantages about value investing is that we take a little bit lower risk than we might with a growth strategy, because we're looking to buy companies that are trading at a discount already. So we're buying into companies that have already come down for whatever reason that we believe might have a pretty good runway going forward. The value approach is more suitable for investors that are looking for a little bit more stability over time. So if you're somebody who gets nervous about the markets, the value approach, might be for you. The growth approach, on the other hand, is where we're looking for companies with the potential to outperform the market over time. So what we're trying to do here is really maximize our return. Now that does mean we're taking more risk, but there can be much higher potential returns over time when you're focused on growth. And this is an area that can be suitable for investors who are comfortable with volatility and have a higher long-term outlook. They realize that they need to invest for 5 or 10 years, not for 1 year. And that longer term gives them the opportunity to take advantage of companies that are fairly new that have an incredible amount of potential. Think about technology stocks back in the early 90s, or stocks like Tesla in the last 5 years. Some of these companies have been phenomenal opportunities, And in the value strategy, we may miss out on some of those incredible gains that we could achieve on those type of stocks. Whereas in growth, those are the kinds we're looking for. So there's higher potential returns over time, but there is also more potential volatility in the short term. Now, we talked about the different styles of investing, active and passive. We just talked about two different approaches to active investing. Now, I just wanted to put up the different investment strategies that we offer with each of those. A lot of our clients are already familiar with this screen. We have the different models between Sukuk, conservative, income, moderate, growth, and aggressive. So whether you're investing in our value approach or growth approach, you have these choices to consider. You can be aggressive value or you can be aggressive growth. The further you go to the right here, the more volatility you can expect. If you're in an aggressive strategy, we are looking for companies that we believe can give us a higher return now. And we might take more chances than we would if you were in our conservative strategy. So it's very important to be in the right place and to have the right expectations when you're in one model or the other. I've seen clients who have come on and said, look, I want to be really conservative and I don't want to take any risks. And they end up in the conservative model and they're doing 4 or 5% a year. And then they're wondering why, if the market's up 25%, they're only up 4 or 5%. If you want to achieve higher returns, you have to expect more volatility as well. The two go hand in hand. It's about risk and return. So for higher potential returns, you'll have to expect a little bit, potentially more volatility in the short term, but long term, you can expect higher returns. And these models are split between stocks, Sukuk, and real estate. Most people are familiar with individual stocks or stock funds, and most everyone is familiar with real estate as well. But Sukuk is a little bit different. Sukuk is our alternative to fixed income investing. As you may know, bonds are typically used in conventional investment management, and bonds are effectively a riba-based product. You're effectively loaning someone money at a fixed interest rate, and they're paying you that interest until they're able to give you your principal back. So that, by definition, is a riba-based transaction. A Sukuk, on the other hand, is different. This is an asset-backed transaction. So, for example, if you're wanting to buy a car and you don't have, $20,000 to pay for a car, you could go and borrow money, but then you're engaging in riba. Your alternative is to lease the car. You could have a Sukuk arrangement where I go and buy the car and I lease it to you. And when you can afford to pay for the whole car, you can buy it, or you can just continue leasing it until you no longer need it. Now, the advantage for me as a Sukuk holder is that I'm getting that rental income or that lease income from you while I'm renting it to you. It could be a home, it could be a car, it could be business equipment. There's some Sukuks that are buying airplanes, others that are buying whole shopping malls and leasing them back to a large private equity firm. So there are a lot of different types of Sukuk arrangements, and they're asset backed. Now, what that means is if I'm leasing you a car, that car has some value. If you're in an inflationary environment like what we're seeing now, then odds are those assets can also come up in value. So Sukuks have turned out to be a remarkable investment opportunity. The average bond aggregate last year, that means all the different types of bonds, if you put them all together, how did they do in 2022? They were down about 13%. Sukuks were down about 7%. So we were still down, but we outperformed bonds. So Sukuks are a really important investment category, and alhamdulillah, we're very fortunate to have that as an offering for our clients so that they can avoid riba and invest in an alternative type of security that will allow them a little bit more flexibility in achieving a dividend without as much volatility as you might have in stocks. So that's kind of my overview on the different types of investment strategies we have, the different investment styles that we offer, and the different approaches that you can participate in. Now, these are all, like I said, a menu of services or that are available to all of our clients. We have grown quite a bit over the years, and some clients who have been with us for a long time may not be aware that we have some of these other offerings. And that's one of the reasons why I wanted to review that in this meeting, so that everyone's aware that there are these different strategies. There are times where it's necessary to make a change. Just as an example, if you started an education savings account for your child, when they're 2 years old, you can afford to be a little bit more on the aggressive side. As they're getting older though, and as you get closer to college, you're going to want to switch from aggressive to growth, and then at some point to moderate, then at some point to income. And by the time they're in high school, you probably really want to be in conservative or maybe even our Sukuk strategy. That way, that money is there and you have less concern about stock market volatility. And these changes can occur at any time. There's no cost to make a change. You can change your model today and then change it again next month if you want. I don't recommend changing models all the time, but theoretically you could. When you're talking to your advisor, this is definitely something you want to discuss, and revisit that. Am I in the right strategy? Maybe your life situation has changed. Maybe you don't have the same job you did last year, or maybe you're now married, or maybe you have more children, or whatever the situation is. Life circumstances do change over time, and so revisit the model that you're in and think about the strategies, and feel free to change them anytime. For the next section of our year in review, I want to now talk about the markets and some of the results of investing last year. If you recall, or anyone who was in our review last year, we talked about TINA, which is there is no alternative. TINA stands for there is no alternative. There was really nowhere else to invest. Interest rates were extremely low. It was very difficult to find good alternatives to the stock market. In 2022, I would say things have really changed. One of the things I like to remind everyone is that the only thing permanent is change. And one of the things that we've begun to see is that alternatives have begun to emerge as interest rates rise. Value investing has made a comeback. Bonds have gotten much cheaper. Real estate has come down and is looking, a little bit more interesting. But there are different options. So this year is definitely going to be a year where there are alternatives. And in my opinion, active investing may very well likely outperform passive investing. We've all heard a lot of different television commercials and gurus talking about passive investing and how it's the best place to just park your money and leave it and not really think about it for very long. And you could do that, but passive investing works really well when the markets are going in the right direction. And for the last decade, when interest rates were very, very low, we've had the perfect circumstances for passive investing. However, last year, and probably this year too, active investing, I believe, is making a comeback and is going to allow us to do some things that you really can't do in a passive approach. Let's start by looking at how the markets did. This is the S&P 500, which I mentioned earlier. The S&P 500 is one of the main benchmarks that most firms around the world look at when they're thinking about stock investing or mutual funds. This is the measure that everyone wants to beat. This is kind of a gauge of how did the markets do. These are the 500 biggest stocks on the market. And so last year was not the best year for the S&P 500, it was down 19.44%. So not the best year for most of us, and most of you who have invested have probably seen some losses in your portfolios, whether you're with us or elsewhere. It was really hard to escape because all of the different sectors got beat up quite a bit. And one of the reasons I believe this has happened is that we had such a big run up prior to this. In 2021, we saw a huge run up in the market. And I think the concerns with COVID were that the economy wasn't really going to move forward very well. There's going to be a lot of uncertainty, and we're not sure what life after COVID is going to be like. And so I think the government stepped back from really doing much, and interest rates stayed really low for a really long time. And so a lot of securities really took off, especially tech stocks. And so when we look back at last year, tech stocks are one of the areas that really led the way downward. I'm going to show my next chart here, which shows how Sharia compliant investing did. We saw that the S&P was down 19.44%. Sharia indexes were down about 23.48%. Now, why did Sharia investing do a little bit worse than the S&P? The reason is what I just mentioned about technology. In Sharia investing, we avoid financial services, and we avoid quite a few other industries which are not compliant with Islamic values. And so what happens is we have a little bit more in technology and in healthcare and in some other areas, but technology is probably the big one. So with that extra exposure to technology, and with technology taking a beating last year, it stands to reason that Sharia compliant investing will also come down a little bit more than conventional investing. So let's take a look at technology in general and the NASDAQ specifically. The NASDAQ is a benchmark of technology stocks. And the NASDAQ itself was down 33% last year. So Sharia compliant investing actually did outperform the NASDAQ, even though technology stocks were a pretty big component. So technology is really the big story here. I think that's what really drove us down last year and caused a lot of angst to a lot of people around the world, or anyone who is investing in stocks. Technology was definitely a challenging situation. There were a lot of geopolitical issues as well. We were dealing with what was happening with oil prices, and Europe is still suffering as a result. And a lot of that had to do with Russia and Ukraine and the geopolitical tensions there. We also had issues in China with COVID and production being a lot lower than it normally would be. So we had a lot of these tensions impacting us. The sectors across the board were all down except maybe energy. And so the investing results from 2022 are not as impressive as we might like. However, looking longer term at some of the Sharia indexes, take SPUS, for example. This is one of the ETFs that we use for Sharia compliant investing, and it's also a good benchmark that we use even against our active strategies. SPUS was down 22.76% last year. But on an average annual return, it's still outperforming conventional investing. So when you compare it to the S&P 500, it's beating the S&P by about 2% a year. That's something you can validate on pretty much any website. You can go to the SP Funds website, take a look at the SPUS performance against the market. So there's still a strong reason outside of just wanting to, outside of wanting Islamic values, but just looking at performance, there's a strong reason to be in Sharia compliant investing. This goes back to the fact that we're avoiding riba. So what does that mean? That means we're investing in companies that are well capitalized, that don't have as much debt. So it kind of stands to reason that even though the NASDAQ is down 33%, we're down 22.7% in our Sharia compliant index. because we're avoiding companies that have a significant amount of leverage. So we're basically hedging against leverage. We're investing in companies that have a lot of debt. If I was to tell you, hey, let's go start a business and we're just going to borrow a ton of money and start this company, you're probably going to have some concerns. As it is, most new business ventures go out of business very quickly, and debt is one of the reasons. Peter Lynch once said, it's really hard to go out of business when you don't have debt. And so there's a very strong argument for Sharia compliant investing. Now, having said that, that doesn't mean we're going to be immune to downturns in the market. So looking at the returns overall, again, S&P was down 19.44%. SPUS, which is our Sharia stock index, is down 22.76%. So a little bit worse, and again, that's because of technology. SPSK is our Sukuk ETF. That was down 7.75%. So obviously, in retrospect, if you're investing really conservatively, you're doing a whole lot better than the S&P 500 because you'll have more Sukuk in your portfolio. Real estate, on the other hand, had a very bad year last year. Almost as bad as the NASDAQ. And this again is because of interest rates going up. And with higher interest rates, fewer people can afford to buy homes. So it stands to reason that real estate will come down in this kind of market. Now, having said that, my view on this is that in our case, SPRE or Sharia compliant real estate really shouldn't be down as much as it's showing here. So I think it might be a little bit oversold. That's my personal opinion, because even though we have real estate, most of our real estate has less exposure to debt. So higher interest rates won't impact us as badly as it would a conventional REIT. So in my opinion, SPRE is a really good place to be. And in our value models, we did trim out of real estate last year, and then we started buying it back in December because at this lower pricing, it's a much better valuation proposition. Now here I've outlined our passive investment styles and the performance we achieved, our active value style, and our active growth style. All of these, unfortunately, are all negative. It's not every year that we see this, but last year was one of those years that a lot of people are lamenting about. But one of the things that you'll hear about in a little bit here is that it's very rare for the markets to continue this kind of trajectory. Usually when you've had a year like this, we're going to have some type of return the next year. It's not common where the markets are going to continue to slide. There are periods like the Great Depression where we might see that, or World War II, but otherwise, we're not really going to see that very often. And my inclination is that the markets just became a better deal. As a value investor, I like buying stocks that are good deals. It's kind of like Black Friday shopping. Any of my clients who might be on this call have heard me talk about that before. I love Black Friday sales, and the market may be on sale right now, so this is a great point in time to try and take advantage of that. So the first couple of weeks of the market have already shown a pretty nice upward trend, and a little bit of a recovery. And that's something that we're really enjoying. And I don't know for sure that that's necessarily going to continue, but I do expect that this will be overall a better year than last year. Our value models, we outperformed the S&P. We outperformed the Sharia index in all of our value models. We outperformed the S&P on all of them except aggressive. And aggressive, unfortunately, we were outperforming the S&P all the way until halfway through December. And we had taken a little bit more aggressive posture and bought a little bit more technology. And we also bought Riot Blockchain, taking a small position in a crypto type stock, looking at it opportunistically. And unfortunately, it didn't pan out as well as I would have liked. Aggressive strategies are about taking a little bit of risk. And so we underperform the S&P 500 in our aggressive strategy. But long term, we're still doing pretty well overall in our models. And inshallah, like I mentioned earlier, I do expect this year to be a much better year. For our growth models, Ali Radha, who's our portfolio manager for the growth style, will go into more detail about the strategies there. But I just want to emphasize that is a much more aggressive style investment. And so when you have good years, they tend to be really good. And when you have bad years, they're not going to be so great. So I'll leave Ali Radha to comment more on that later. But before we get to the growth models, I want to talk a little bit about sector allocations and kind of give you a little bit of insight into how our models are constructed and the kind of things that we look at when we're choosing investments and putting these portfolios together. One of the very important considerations is sector allocations. So what this means is, the S&P 500 is split between 500 different stocks. Now, out of those 500, what industries are we talking about? What types of companies are we talking about? These are all categorized, as you see on the slide here, consumer defensive, healthcare, utilities, communication, energy, etc. So each type of stock is categorized in a sector. And then the S&P 500 itself, you can see what the totals are for each of these sectors. So if you look at technology, for example, you can see that 25% of the S&P 500 is technology stocks. So technology is a very important sector for the market and for the S&P 500 because it represents the largest single sector of the market. So when you have a year where all technology stocks are dropping the way they did last year, then it stands to reason that the markets are going to be down. And if you look on the column on the left here where it says SPUS, this is the Sharia stocks out of the S&P 500. So if the S&P 500 has 25% in technology, you can see that in Sharia investing, 40% is represented in technology. So for passive investors, you're going to follow these sectors that you see here under SPUS. But for active investors, this is where we have a little bit of an advantage where we can actually tweak this to focus more on areas that we believe are going to be better and focus a little bit less on areas that we're concerned about. So if you look here for our aggressive model, we're fairly well in line with the S&P 500, but there are some differences. We have a little bit more in basic materials. One of the reasons for that is, well, if there's going to be an inflationary pressure, material costs should go up. And as the economy starts to return back to normal or at least start to improve, the demand for materials will start to pick up. And at their newer cost structures, we should see much more profitability. And, I tend to be more bullish on that area. And so we have more emphasis on material stocks. Obviously, we don't have financial services. But these are the things that, as a portfolio manager, we have to choose the sectors very carefully based on what's going on. And fortunately, we have a team of portfolio managers at ShariaPortfolio, so we can all discuss this and learn from each other and get ideas from each other. And, even with the sectors, we can kind of get some idea of, which sectors are going to be the better place to be right now. If we move on to the next slide here, you can get a pie chart idea of how the S&P looks compared to our aggressive model. So you can see that there's some things that we have a little bit more of than the S&P 500, like real estate, for example. We're more invested in real estate than the S&P 500 is. We have a little bit more industrial stocks. Technology is nearly the same, but we have more basic materials, as we saw earlier. So these allocations are really important because this is where we as portfolio managers are kind of making a call that we want to be a little bit more focused on one area over another. One of the things you'll notice here is that we have an allocation to Sukuk in aggressive. Sukuk is normally not something we put in our aggressive model, but because of the stock market turbulence we've seen, we've put a little bit more Sukuk, and we're using that as a way to stabilize the portfolio to try and improve some of our clients' positions. One of the ways to make more money is by losing less. If the markets were to continue to slide, the Sukuk would really give us a nice cushion. If the markets, on the other hand, go up from here, we may lose out a little bit of return from that, but that will be erring on the side of caution, which is something as a value investor I don't mind doing as much. Here's a case in point on sector allocations. This is our actual breakdown for our aggressive model in January 2022, and then 6 months later in July 2022. So you can see how things changed. We really stepped away from technology, which used to be about 36% of the portfolio, down to about 22%. We increased consumer defensive, which was only at about 1.5%, up to 8.5%. So this is a real example of how we maneuver our models based on what our expectations are in these different industries. So it's one thing to pick a great stock, but it's also important to have some feeling of how different industries or sectors are going to perform. If you had bought the very best technology stocks last year, you'd have some great stocks, but you'd most likely be down, as we saw earlier, with the NASDAQ around 33%. If you instead decided that, well, maybe I'll move a little bit of that money into defensive positions, or maybe healthcare or energy or something else, it'll really help you balance things out a little bit so that you are protecting yourself. So it's not all about just making money, it's all about not losing money as well. These are both very important points, and sector allocation is one of the tools that we use to try and help ensure that we kind of try and minimize our losses. Now, for our expectations and forecasts, that's our next section in our review. The main thing I'd like to say here is that I do expect some choppiness in the market. I'm not expecting that we're completely out of the woods yet. My suspicion is that the worst is behind us, because we're already beginning to see some recovery overseas. In our value models, in fact, I think in all of our models, we've begun to invest a little bit more internationally, because as much as we've seen some pain in the US markets, there's been even more pain overseas, and the opportunities have become a lot more attractive in the international markets. And so my expectation is that it might be a little bit more choppy in the short run, but I think longer run, it's going to be a really good opportunity to buy in and take advantage of a good Black Friday situation. With that, I'd like to turn it back over to Ali Radha, who manages our growth models. He's going to talk a little bit more about the 2023 expectations and forecasts, and then he'll also discuss the returns for our growth models. It's all yours, Ali Radha.
All right, thank you so much, Nashad. I'm gonna try and jump in so as to be able to get as much covered in a short amount of time. As you all know, we are at the hour mark, but I do think that it's important to make sure this is covered. I'm trying to, right there, that's the thing I wanted. Okay, so on my presentation, I'm gonna focus a little bit on the macro environment and talk a little bit about what happened, and then also dive into kind of some of the growth strategies. I won't do it as granular as what Nashad presented, but if any client wishes to have that type of discussion with your advisor, they're happy to do that on an individualized basis. because I think it's important to also cover the macroeconomic kind of environment, some of the discussion around that. As you all saw, 60-40 portfolio last year was one of the worst in over 100 years, and primarily because bonds were affected just as badly as stocks. TLT, a common bond ETF, was down 30%, although our Sukuk, alhamdulillah, did quite well. But that was one of the reasons that there was really no place to hide. And we'll come to see that in some of the other slides as well. So just keep that as some of the perspective of what transpired last year. As Naushad pointed out earlier, it's very, very rare for us to see back-to-back negative years. And there's 4 instances where we saw that in the past. And in the 70s, for example, interest rates were being increased at a time where we had imported inflation because oil prices were going up. And a lot of that had to do with geopolitical events, kind of like what we're seeing now. And the Fed's response, at that time, we believe was not the best in terms of hiking. I do think that the Fed may have learned from some of that and hopefully can consider taking a softer approach this year. But we'll wait and see what happens. But of course, so far we do think that, as you see, there's a lot of green compared to the red. And with the way the market has started, the first 5 days is usually a good indicator of what is to come. According to the traders, stock market traders almanac, when the first 5 years are positive, first 5 days in the year are positive, then 80% of the time the market ends positive that particular year with an average gain of 13%. So again, we're not going to necessarily be fortune tellers here, but the starting is usually a good indication of what may be to come. So, and we saw this year has been off to a decent start so far. I'll talk a little bit about inflation, which has been one of the main things that the Fed has been trying to combat. We've seen that in the beginning of COVID, used car prices had gone up substantially, and so far we're seeing that they've come down almost 15% year over year declines. And in the beginning, it was an indication of the inflation that is to come. And now it can be seen more so as a leading indicator of inflation to drop, because used car prices, if you look at the chart, they've actually been declining. We've also seen signs where the CPI, which is the Consumer Price Index, you've heard a lot about that in the news. It peaked in June at 9.1%. Last year, and we're seeing by December it was down to 6.5%. So a lot of good indication that inflation is coming down. And actually this morning there was the Producer Price Index that came out, and that also showed the lowest numbers since the beginning of COVID. So far all good news on the inflation front. A lot of people wonder, is this are we entering a period where there's tightening going on? Is this expected to continue for a longer period of time? I like to highlight something that I think some of you may have heard of in prior discussions. That the debt ceiling is one that just earlier last week, U.S. Secretary Janet Yellen mentioned that the U.S. is very close to hitting that ceiling, and they're going to go through extraordinary measures not to exceed that debt limit. But prior history has shown us that they keep raising the debt ceiling. And according to the Congressional Budget Office, the US deficit is forecast to hit over 16 trillion by the year 2032. So that gives you perspective that, we're running at a big deficit right now. And although there's a whole talk of quantitative tightening, prior years has not necessarily played out this way. Where during bear markets there's tightening going on, and also since 1959 this is the first year that the money supply, the M2 money supply, has contracted last year, I should say. So it's completely opposite of what we would expect them to do. So we'll see kind of where the future hikes go. So far the expectation is maybe a couple more hikes before a pause. And a lot of big banks are projecting possible rate cuts towards the end of this year. So we'll kind of see where this goes. But this is a big problem, because if you have so much debt and then the debt is being serviced at higher interest rates, then the US debt servicing cost is going up. At the same time, tax revenue is declining because when the markets were down, there will be less capital gains, corporate earnings might be lower, so there's less tax receipts coming in from these side. And so, when you continue running at a deficit for many years, you really are debasing the currency because you have to print more money to finance your income needs or your spending needs. And I think that is going to be a big problem as we go forward. But that's also one of the reasons we feel that some of the spaces that are showing attractive growth can do better for us and serve as a hedge towards all of the money debasing that is happening. So let's look at a couple of things here. Naushad talked about international markets. In some of our value models, we have been taking some position in ETF that gives us exposure to the emerging market side of things. We've been taking in the active growth strategies positions in some of the Chinese equities where we do see good opportunity, especially now that they're coming out of the lockdowns and also starting to spur activity because they want to promote growth and consumption. At the same time, the government is going to hopefully be less aggressive with their policies towards tamping down on some of these companies, especially in the tech space. So we do think that there is opportunities that could be presented in some of the emerging markets, and we're starting to see some strength build up in the equities there. And also valuations are very appealing for a lot of these emerging market stocks as well. So just something else to keep in mind. One of the things that was a headwind for stocks for quite some time was the dollar index. And we are starting to see that starting to Q4 last year, the index is starting to show a breakdown. And whereas, foreign exchange was a headwind and a lot of, earnings calls, you may have heard, companies citing that as one of the reasons for poor earnings. We think that as the dollar is declining, that tends to boost the profits of a lot of multinational corporations because it makes their products less expensive in foreign markets. And whenever they report revenue from abroad, they translate their international sales back into dollars. And a weak dollar also is seen as promoting investment in the US. So just keeping that in mind is another tailwind possible for this year as the dollar index declines. Valuations have also come down. Small and mid-cap stocks are trading near 2009 valuations. We believe that a lot of these companies may have already priced in an economic slowdown as well as the recession, which is estimated as 70% probability of happening this year. Large cap valuations have also dropped. You've seen a lot of the FANGs, coming down. Their valuations having come down as well. So we do think there's going to be opportunities within some of the large caps, but also outside of the usual suspects as we go forward. So on the macro front, what are the things that we're seeing that help us kind of feel like we're, optimistic on where the market is headed? Inflation, we said, is falling faster than the expectations. A lot of people are calling for deflation now at this stage because of the pace at which inflation is falling. We also feel that Fed is likely to halt their hawkishness in 2023 with inflation dropping. A lot of banks, as we mentioned, are predicting a recession and a pivot starting possibly in the third quarter of this year. And so this is something I'm sure the Fed is watching as well. US economy has been resilient because unemployment is low. The wage pressures are still there, which is, I know, one of the things the Fed is trying to control, because if you cannot control the wages, there's a possible for inflation to come back. Are we going to be in a recession or a soft landing? There's a debate that is going on out there, but I think that if the Fed has been primarily the reason to get us into this situation, they probably have a good way of getting us out of it as well. We mentioned back-to-back negative years are very extremely rare to see in the history of the stock market. China reopening, supply chains easing, lower PMI and cooling of the dollar index are possible tailwinds, and we'll probably start hearing that during the earnings calls in the next week or so as companies start reporting their Q4 earnings. Valuations have been declining, which is positive for a lot of especially the NASDAQ and some of the tech stocks. Although we do see these as positives, there are some things that we still have to be aware of. Geopolitical tensions could continue. Fed could continue being more hawkish, because a lot of people thinking that they might soften up, but a lot of their rhetoric has been that they may not, cool down on the interest rate hikes. And some of them, whenever they speak, they have commented that they do think there's much more in the pipeline for rate hikes. The market so far is predicting 25 basis points in February, 25 in March, a pause after that. But we'll see kind of what happens. But the take-home message with some of this is what tends to happen with the stock market. From prior history, what we've seen is equities typically trough or bottom 6 to 9 months before earnings reach their lows. So if a lot of people believe that October last year was the low of the market, and if we are entering a recession, and some of commentators believe that we are already in the middle of a recession, as we speak. So we think that maybe March, April could be the earnings low point, but the market tends to react sooner than that. So recovery kicks in before the earnings declines, majority of the time. So, we'll kind of see what happens this year. But longer term, what are the other things in the medium to long term that we are looking at that can help in the investment space? Healthcare spending is increasing. There's an aging population. So we think that, there will be a lot more spending happening to take care of our elderly. Spaces such as medical technology, biotechnology are areas that we see a lot of promise. Pharmaceuticals have done well, especially those targeting disease common areas that are affecting the larger populations in areas like diabetes and Alzheimer's and other cancer type space. There's a lot of opportunities in that area. Technology, of course, we think is going to be an area that the economy is expecting to continue to utilize, because birth rates have been declining around the world. That is one of the issues, especially in China right now, which means there is no labor to replace the retiring population. So that is going to be one of the reasons where technology can come in and alleviate some of those shortages. With resources being limited, technology and automation, robotics and things like that are gonna be needed much more, and will bring about deflation, because cost of materials, cost of goods, cost of labor will decline as much more technology takes over in doing this thing. So I know in the past, some people may call the parallels of what we're seeing today with the tech bubble. We like to think that there may be some similarities, but this time around, what is in favor of technology is how embedded it is in everyday aspect of what our lives are today. Also, the growth and profitability of a lot of companies is there. It's not just the hype behind technology. So like what may have been the case in the tech bubble time. One of the important charts here, Naushad has covered in more depth kind of what different categories did, but I'll draw some attention to a couple of areas like the NASDAQ, which is more representative of the growth strategies, was down about 32% last year. But historically, when you look at the annualized return since 2011, you can see that the average annual return of the NASDAQ constituents are 15%. The S&P is obviously a very good place for those who want to invest. SPUS is a core holding in most, if not all of our portfolios. So you can see that as a good way to be exposed to the market, whether you're in a passive or active style investment strategy. But the crown has been historically undisputed over the last 10 years is Bitcoin, right? And why is Bitcoin important? We'll cover that in a couple of slides here. But last 2014 down 58%, 2018 down 73%, and then we saw down 65%. So every 3 years, we see some strong gains and then a drawdown after that. Part of that might have to do with the, with the halvening cycle that's expected to come in 2024, and markets and the Bitcoin, space, crypto space tends to rally in anticipation, and as we approach proximity to the halving, where the reward is decreasing for the effort of mining. But what is more important, I think, from here is that, look, average annual gain about 148%. While we may not see necessarily those type of returns going forward, we do think that growth style investing takes a little bit of that, and we have exposure to that through some of the proxies, and we'll, companies like Block, companies like CleanSpark, the mining stock is one of the direct ways that we're getting exposure into the space. So just want to put that into perspective, that yes, they do go through drawdowns like what we saw last year, but our expectation is that when life comes back into them, and so far this year, Bitcoin's off to a great start. It's up about 24-25%, and we do think that momentum could build, as we go forward. I'll talk a little bit about Tesla, which happens to be one of our larger allocations as well. We've seen revenues go up over time, and the trend, since 2009 and now has been very, very strong. One of the things that you would expect with the market, and that's one of the things that we've noticed, is that the market does not always behave in a rational manner. You would suspect that with the largest growth in revenue, the stock would go higher, but that's not what we saw this year. And part of that is the macro environment that we, last year that we found ourselves in. But we do think that in the medium to long term, a company that is growing revenues at such a fast pace, that is innovating, should be rewarded, and valuations are very, very reasonable for where they are at present time. When you look at something like the PEG ratio, which is something that we look at closely for the growth strategies and some of the growth holdings, Tesla is currently trading under a PEG of 1, which seen as a very, very cheap stock for a company that is doing what it is. Also, when looking at the sales, in 2022 compared to 2021, Tesla vehicle sales have been increasing. General Motors is slightly up there, but almost every other car company has been declining. And so, if this trend is to hold going forward, it looks like the future is quite bright for Tesla going forward. On the left-hand side here, this is a longer-term history between 2015 and 2022. Used car prices have been declining, but we also believe that ICE companies are going to be declining in popularity, especially as battery electric vehicle penetration increases. Our expectation is that it's currently around 10 to 12%, and it's expected to rise to almost 50% over the next few years. And that should be very positive for the EV space. So Tesla kind of is one that's, on that chart also showing, as that is increasing, the other companies are showing a decline. On the other hand, I want to turn a little bit of discussion into the chips side of things. Global AI processors for cloud data centers, automotive, 5G, these are areas that are going to continue to see a lot more money in that coming into that space. And we're seeing that the demand is expected to surpass or the volume by 37 billion in 2026, which is representing a 52% compound annual growth rate since the year 2019. So despite economic slowdown, this space is seeing tremendous growth. And we do think that a lot of these, chips and processors and cloud-based, companies should see a lot more growth and going forward. I talked a little bit about Bitcoin in the previous slide, but one thing we've started to see actually is that if you do take into consideration dollar cost averaging, despite the volatility that we saw last year and the decline in pricing, if you were to buy every Monday the same amount, then your average cost price last year would have been 25,000, and so on and so forth for the prior years. With the mining stock, that is a much more cutthroat business. A lot of miners actually went under last year with Core Scientific, as being one of the main ones that we might have heard of. There was also a lot of blow-ups with FTX and Three Arrows Capital and other things in that space, the black swans that contributed to the decline in Bitcoin prices. But we do think that, with the recent turn of events this year, there's a little bit more money coming back into the space. Accumulation has been strong. And that partly could be related to the the fact that the space tends to rebound prior to the halving cycle expected in 2024. From the mining category, we believe CleanSpark is one of the best mining stocks from an efficiency point of view. They have been growing in strength. And we do think that going forward, they should do well because they have less debt. Debt is one of the big problems, as you know, that has affected a lot of the miners, and we try to avoid those things in our investment selection process. But this chart I'm going to leave as on the Bitcoin side. One of the last things I'll mention here is that as the supply is decreasing, the adoption is increasing, the price is expected to go up. This is the one asset class that is seen as being a hard asset, or one of the hardest assets out there because of the fixed supply. There's only 21 million coins that will ever be mined, and currently there's only about 1.5 million possibly available for purchase. And considering the debasement of money currencies and fiat currencies due to all the money printing to sustain all the spending that's going on, we think that real estate and hard assets are going to see a lot more adoption, and this is an area that we're going to be watching very closely going forward. So we are selectively bullish. We do think that markets, have opportunities, and this is a stock picker's market where not everything is going to float like we saw last year. Some areas did better than others, and we think going forward, similarly, there will be pockets that will do much better this year compared to last year. And so being more selective will be very important. But on a broader level, when the S&P is down 25% or more, that's the following 1, 3, 5, and 10 year from this chart shows that things tend to be very, very positive. So, people are more pessimistic, sentiment has been down. But we do think that, as Naushad has been mentioning, Thanksgiving sale is here with a lot of stocks out there. And so we do think that, it's creating a good backdrop for accumulating and purchasing and dollar cost average. So I'm going to leave this last slide here. This is a comment I found from Mitch Zacks, who's with Zacks Investment Group. I found this, that is important for investors to remember that bull markets typically start during a recession. A lot of people argue or make the case that we probably are in the middle of a recession already before corporate earnings reach a low point. So, the stock market is generally an indicator of future, earnings and business conditions. So if you expect the economy to struggle in the first half of this year or to improve later this year or even next year, this could be the time to start owning stocks, especially companies that are profitable, have strong balance sheet quality, are innovating. We think that those companies will get rewarded. Corporate earning estimates have already come down. A lot of those have priced in a recession to some degree. So, we think that we're closer to the inflection points and opportunities for investors not that far away. And when things do rebound, things in the growth space tend to move fast as well. So dollar cost averaging is going to be one of the best ways to remain invested, especially during periods of high volatility. You're able to let your money ride further for you. If a stock is down 50%, for example, and the fundamentals remain strong, one can see that as an opportunity to buy twice the number of shares for the same price. So hang tight. I know it's been a rough year last year. We do think that there are some shoes that may drop in the crypto space. We do think that equities may have some more room to fall, but by and large, the opportunities are there, and we think that as earnings reports come out, we'll start getting a better glimpse as to what is to come, as the year progresses. And inshallah, we're here for you. We understand it's tough to be down, But I think that this is unprecedented with the rate hikes that we've seen. We think that some of that softness might come in, and the moment the market senses somewhat of a pivot or a swivel or whatever you want to call that, we think the risk will come back in. There's a lot of underinvestment in US equities right now. Fund managers have been sitting on cash. There's still, although a lot of disposable income has already been spent, there's still a ton of money on the sidelines. And we think that as that drops back into the markets, we should be able to see much more positive action here on the price side. So with that, I'm going to pause. I know we've taken a little bit longer than we would have hoped, but we truly appreciate you tuning in and listening to us for this important presentation. And we hope that it has benefited you in your investment journey and outlook as well. So any questions that we can address at this time?
While you were speaking, I was answering a lot of the questions in the chat. So
I think that
there was one question about express and passive investing,
right?
And maybe elaborating more on the passive strategies and what's happening there. Did you want to share any thoughts on that?
Yeah, so our express service is built more for those who want a more hands-off type approach. So if you want, you're getting started with the investing space, or you may already be someone who has been in this space for a while, but you do not want the active style, a passive style works best for a lot of buy and hold investors, or those who want less hand-holding, those who want less tinkering. And so, our express service could work well for those types of investors, where primarily a lot of them end up into our passive strategies. And it's a more economical way of investing. So if you want to consider that, you're welcome to connect with one of our advisors, Shafaq Qazi, who's happy to discuss further with you more about the express service and help answer any questions there as well.
There was also a question about zakat and how that works in relation to the portfolios. Maybe Sheikh Omar could elaborate on that.
Yeah, the question, I wasn't sure. I think it was asking, first of all, if we pay zakat on stock, and the answer is yes. I think the point that I wanted to make earlier was that the zakat that you would pay on stock can be less than the zakat that you would pay if you just had cash. So as an example, if you had $1,000 in cash, right, you would have to pay zakat after a year has passed by of $25. But if you were holding shares worth $1,000, and if you have intention that's a long-term investment in a business, not that you're looking at the stock as a commodity, but that you're looking at the stock as a business, then you don't pay on the value of the entire stock. You only pay on the cash, the accounts receivable, and the inventory that the business has. So I know that's somewhat technical, and you might need to work with an advisor to figure out what your zakat due is. But in effect, what that means is the amount of zakat that you pay is significantly less on the same size portfolio. The same $1,000, instead of paying $25, you might be paying something like $5, for example. So
right. Yeah, and for anyone who wants to learn more about zakat and how to calculate that, we have some webinars that we did that you're welcome to check out with Sheikh Arij, where he goes over the zakat calculation, and we cover the simplified method as well as the the more calculated method that Sheikh Omar Khan was discussing here. So please check that out. We will inshallah plan another zakat webinar this year as well as during Ramadan. So do keep an eye out for what newsletter and updates on the webinars that we're going to be doing. And hopefully that question may be addressed, once again during that session. But check out the recording and hopefully address your questions there.
There have been a lot of questions about the ETFs, so I tried my best to answer a lot of those. One of the questions right now is on the timeline for new products. Inshallah, we do have the intention of launching some new products this year, and what we're expecting is to have some in the summer, and then inshallah some additional ones by the end of the year. So, that's just our rough timeline. We're already, working with exchanges and with some, several banks on some ideas. And inshallah, if you're not already on the SP Funds mailing list, please sign up for that, and you'll be the first to know as soon as we launch a new product. But thank you for all the comments and for all the encouragement. We really appreciate that, and inshallah, we really appreciate the support of everyone here.
All right. Any other final thoughts, comments from Nashad or Sheikh Omer as we wrap this up? Anyone who has not had their question addressed or has additional questions even after this, please do reach out to us. You can always submit an inquiry on our website if you are new to Sharia Portfolio, or if you want to remember our phone number, it's very easy, 888 Halal Stocks, and you can get through to us directly that way. But of course, we have a lot of different resources on our website. Our team is able to answer your questions offline as well. So we do want to emphasize that. But any other final thoughts, comments, Nashad or Sheikh Omer, that you want to share?
Well, I really appreciate all the support and everyone that joined today. And yes, as you said earlier, if anyone's looking for more advice or we didn't cover your questions, please contact us individually. You can book a meeting with anyone on our team right through our app or right through our website. And inshallah, there's a lot of things that are new, not just the ETFs, but even, the way we manage our models, the different offerings, like we talked about earlier, between passive and active and growth and value. And, there's a lot to unpack there. So, don't hesitate to contact any one of us to get some good one-on-one advice and feedback. And thank you all for being here today and attending. And again, thank you for all that encouragement. Appreciate it very much.
Thank you. Any last words of advice or comments from Sheikh Omer?
No, I think those are important. Some of the important concepts you shared there when it comes to investing that are also aligned with long-term Islamic goal management, right? You talked about dollar cost averaging. So it's one of the best ways. I think it's one of the best ways to get into the market, or the best ways to kind of protect your returns from making sure you are investing in a wise way. So you're always getting good pricing. If the stock goes low, you benefit from that. If the stock goes high, alhamdulillah, you also got in a wise way. So I think for those that didn't understand maybe some of the things that Ali Rada was talking about, contact your advisors, get to know this a little bit better. But the smart thing to do is to continue to invest on a regular basis, both from an Islamic standpoint as well as from a just financial savviness. And so it's good to hear you talk about, as you talked about different parts of the market. I saw you consistently share that message about dollar cost averaging.
Thank you. So yeah, I appreciate you all. Again, we're gonna be doing much more of these webinars this year. So for those who are tuning in for the first time, just keep in mind, we're here for you. So if you guys have suggestions on topics or content that you feel would be helpful for us to go over in the Islamic finance investing space, let us know. If you want us to come to a local community where you're based and do a seminar for the community there, we're happy to coordinate something this year or in coming months, whenever it's feasible. And you might catch us at some of these events at the ICNAS and the ISNA conventions and so on. So we're happy to meet you there. But we truly appreciate you, being a client or being a participant and learning about this, because first step to improving your life is to be able to gain the knowledge about these things. And for you participating and tuning in, we are truly grateful, and we hope that you have a blessed and successful year ahead. And without anything else here, we'll thank you all. Assalamu alaikum wa rahmatullahi wa barakatuh.